What's up, guys? Welcome back to this channel, Trade with Ricky, which is me. So the video before this one, I talked about Bitcoin and what's my take on Bitcoin currently and what's my long-term view. Today, I'm gonna basically go even further. I'm still gonna talk a little bit about Bitcoin, but I'm gonna just talk about a really important topic in economics, which is speculation and bubbles, because it's important to understand when a bubble is formed and what can be the consequences. To do this, I'm gonna sponsor this book over here, which is really useful, really important book about bubbles in history, and it's called Miners, Panics and Crashes. And it's written by Robert Z. Aliber and Charles P. Kindleberger, and there is also an overview made by Robert Solov. If you guys study economics like I did in college, Robert Solov is important because of his model, the Solov growth model, which if I have an opportunity I will explain you guys in a different video. So this book is important because it goes beyond the major crashes. So it's not just an history about crashes, but it actually explains in every single detail how a bubble is formed, and when it pops, and what are the consequences, and what the government should do to avoid bubbles. With that being said, I have this picture in my desktop right now on my browser. And this is really a really cool picture because it explains perfectly the stages of a bubble and how to spot a bubble, when to buy, when to sell, and so on. Because many people are afraid of a bubble because usually there are so many consequences. Like usually, like when a bubble pops, the price go all the way back to the regional price and even lower. So if you buy at all-time high, you're really going to lose your money. But you also can make lots of money in these speculative assets if you know how to catch a bubble. So if you buy a bubble when it's at the early stage, which it's called the smart money stage, because very few people invest, very few people know about the asset. If you invest there and you know when to sell, you're gonna make lots of money. Basically, you want to avoid to buy a bubble, to buy an asset, a speculative asset, when it reaches the top and when it's about to decline. So let's start from the beginning. So valuation, smart money, takeoff phase, that's a steal phase. Then it goes up steadily. It's now a huge up forward line, as you can see. It's always like this because more and more people start to invest in this asset. More people start to know about this asset, so the price goes up. But it's still not a really common asset. So you see the first takeoff here. Then you see a small sell-off. Original investor, they want to sell. And this is called a bear trap, because bear trap is basically when there is a small decline, but it's gonna go up back immediately after. It's not gonna go lower. And this is called the overhang phase. This means when actual investors get to know about the assets, they get to invest. Then after this, we have the mania phase, which once again it's underlined here, manias. And basically what happens is when this asset goes mainstream, everybody, not only institutional investors, but retail investors, so someone like me, someone like you, gets to know about this asset because it's so common, so everybody gets involved. And so you see this enthusiastic wave that brings the price up brings the price of the asset up all the way to really all-time high, which can be like 100 times the price from the initial stage, and so on. Then once you're there, people starting to realize that it's time to take their money. So people take their money, most of the people that bought in the still phase already sold their shares. People that bought, institutional investors already sold their shares. So people that are losing money here are the people that bought here in the enthusiastic phase because they think the price is going to go up even higher. But at the end, this is not what's going on. So this is the most dangerous phase over here, because if you get caught in this enthusiastic phase too late, so you start to become greed, which for me, greed is the most dangerous emotion when you invest and when you trade. I will explain the psychology behind greed and behind fear later on, how important it is to understand those two concepts. So once you are in the greed phase, delusion phase, new paradigm, and then small decline, then you see another small bump and you think it's a return to normal, but then you see this huge wave going down, and this is a fear wave. Fear that you're going to lose all your money. And so it's a big drop. As you can see, greed and fear, two major topics when it's investing time and trading time. And then the greed phase here is over, and now the fear phase takes over, and it goes down all the way back to the initial phase, and even lower, and then there is a small increase, but then basically return to the mean, and the money is gone. The bubble is popped, nothing else to do. And if we go back to Bitcoin, and I want you guys to, hopefully the chart, let me close this, let me close here. Yeah. Okay. So if you guys can see, so initial phase, people start to get interest. This is the phase where the institutional investors get involved. Bull trap here. Bear trap. Bear trap here. Then enthusiastic phase here. And then all this phase is all greed. Enthusiastic phase. Top. Bull trap. Fear. And you see decline. And now it's declining and it is returning to the original. And I talked about my previsions about Bitcoin in the future, so I'm not going to repeat myself, but I'm just comparing this. See, memorize this chart to give you 3 seconds, and then once you guys are done, compare to here. Same exact chart, how to spot a bubble. One more bubble I'm gonna show you guys is the 3D printing system. In 2014, there was a huge interest in 3D printing because everybody thought it was going to take over, it was going to take over the manufacturing industry. So as you guys can see, for many years, this is 1989 all the way to 2010, the price was basically steady. But then there is an initial phase here. Investors, initial phase, bear trap, and then this long wave of enthusiastic phase. People get involved, people getting delusional and greedy. They get so greedy, and then people that bought here, the initial investor, the institutional investor, they're like, we want to take our money, and then you see a drop. Fear takes over. Over here, you see those 2 red candles. Those represent a bull trap. So that's just a dream that the stock is going up again. No, and if you're caught here, fear takes over. Big drop, return to the mean. Now 3D printing is trading about 1447. And which is at the original resistance level in 2011. And this 3D printing was up in took In 1 year, it lost everything. In 1 year, it went from 100 to 8, and now it's just now trying to recover. One more example. The very first example of financial crisis, the tulip mania, 1634 to 1637, 3 years. So we are in, so this is called the Dutch crisis, and basically people get involved in buying tulip bulbs, no, a particular type of tulip bulbs, and as you can see, the price started to increase. Then the greed phase takes over, takes the control, and then once you reach 60, and I don't know what's the actual scale, what this 60 represents. It can be $60,000, I don't know, but and then it goes all the way down, and it really kills the initial investments. One more panic, one more bubble. South Sea basically was a bubble that popped in England. South Sea Company was basically a stock that bought the English debt during the English and Spanish War, and basically they were buying English debt, no, in order to refinance the government, right? But what happened though? Once again, initial phase year, bear trap, greed takes over, delusional, boom, bull trap, fear, and gets done. Also, then over here explains you the speculative mania which swept Europe in 18th century, focused in England and French economies, based by overspending for constant warfare with their neighbors. These two countries turned to schemes issuing securities to refill their depleted securities. Basically, they were financing the wars with those debt securities. The need to speculate all this time became all encompassing. The above chart shows the mania that went extreme, and they collapsed in the mid-1720. In French, it was called the Mississippi Land Company. So see, and then one curious fact is that one of the investors that bought this stock here and lost all his initial investment was one of the greatest mathematicians ever to exist, and was Isaac Newton. Just to point out, you can be the smartest guy in the planet, but bubbles can be really hard to predict and can really kill your portfolio. You can be the most be aware financial guru. No, you can be like the best investor out there, but the most intelligent guy. But when there is a bubble, you have to be really careful. You don't. It's hard to predict. No. And then one last final comparison is the Nikkei. And this can be a scary one because this is a long bubble process. No, this chart is not currently updated, but I can tell you guys that right now Nikkei is trading around the 20,000. So it broke the previous resistance of 18,000 in 2007. So let me explain this shortly, and then I'm gonna close this video. So what happened is that, as you guys know, Japan lost World War II, no? And what happens when there is a war? When there is a war, the main after war effect is the government starts spending in order to recover, in order to fix everything, all the construction, all the house they were burned out, all of that, to lower down employment. Government lowered down interest rates in order to stimulate the economy and so on. So Japan had this big increase in economics in their economy after World War II, all the way to the late 1970. So for 30 years, steady growth. But then what happened? Instead of thinking about the long run and thinking about decelerate their economy in order to stabilize their economy, in the 1980, no, all the way to 1989, they had another boom. No, so you guys know our business cycle is made of boom, no, and then a retreat, no, and then you have a recession and goes up. The Japan economy instead was like boom, boom, boom. And what happened in 1989 is that the economy crashed because you had the boom market for 40 years. No, the economy was going straight up. You never stopped, you never slowed down the economy. So the retail prices, no, so the price of the house were so skyrocketing that the government could not control. So there was a crash. And then you guys can see the Nikkei declined all the way to 2003 in order to recover. So it took about 15 years to recover. This because a mistake that the government made, which was to keep stimulating an economy. Even though the bull market was over, they created another bull market, and this created a huge bubble. After in 2003, so 15 years of steady decline, and now it's just now after 11 years. After 11 years, the Nikkei is trading above the previous resistance point here. So this shows you guys how it's important to understand the economy behind an asset. No, don't let greed take over your investing idea. Psychology is an important factor. No, use your own idea, your own opinion. Don't get caught at the wrong time, because if a bubble bursts, you can really be in big troubles. So with this video, I'm gonna conclude this topic about economic bubbles. In the previous video, which I'm gonna show you guys here, Bitcoin is crashing. I'm talking about the current price of Bitcoin. And I'm gonna conclude this video with this chart. I'm gonna leave this chart for 5 seconds. And once again, a really important book for you guys. If you guys are curious to understand when a bubble is up, like if you guys would have read this book, no, you guys could have understand what's going on with Bitcoin right now. So thanks again, you guys. Please leave a thumbs up, leave a comment, leave a subscribe to the channel. Let's talk. The next few videos, I'm gonna probably go over more about economic stuff, tariffs, and so on. So let's keep in touch.